All right, everyone, let's go ahead and get started. We're very excited to welcome Liz Simmie today. She's the co-founder of Honeytree Investment Management, an asset management firm focused on responsible growth based in Toronto. Together with her team, she manages Honeytree's concentrated active investment strategies for institutional and private clients. Honeytree believes utilizing ESG data is just as important as fundamental data when assessing a company's growth and risk. Honeytree is proud to be one of the few female-led, responsible-based asset management firms leading this conversation. Prior to Honeytree, Liz has experience at a leading active management firm and in quantitative market research. She has a degree in economic statistics and history. We're excited to hear more today about how Honeytree integrates non-financial ESG data alongside traditional financial data in the portfolio construction process for concentrated active strategies. Liz will cover limitations in ESG data and scoring systems and how portfolio managers can overcome these issues. And instead of waiting until the end, I thought I'd just go ahead and let everyone know about some of the events we have upcoming in the local society. Next month, we do have a webinar, February 2nd. It's titled Keeping Your Brain Young, Slow Aging, Boost Productivity, and Lower Risk for Alzheimer's and Dementia. The speaker is Dr. Mark Milstein. In March, we also have an in-person networking event in Birmingham. In April, we're going to welcome Ben Carson on a webinar. His topic is to be determined, but if you follow his blog, I'm sure it'll be interesting. And then on May 10th, we have Capitalizing on Uncertainty, the Value Advantage in Non-US and Emerging Markets. And that will be located at a distillery in Ferndale. We have a couple other events that we're planning for the summer. None of them are yet finalized, but the one that I would like to mention is that you can keep your eye out for registration opening at a golf outing in late May. We're targeting Oakland Hills as of right now. So just be on the lookout for your emails for those. So without any further introduction, I'll go ahead and let Liz take it from here.
Hello, everybody. Let me just get this up and on the right slide. Thank you for having me. Hopefully you can hear me. I heard Michigan did not get 3 feet of snow like we did in Toronto. It's been an exciting couple days. Thankfully, in the investment industry, it's a little bit easier to work from home. Thank you for having me. This is my second CFA Society presentation. I am thrilled to talk about ESG all day, every day with anybody who will listen. And if anybody's on Twitter, you know that I tweet about ESG all day for really anybody who wants to listen. ESG is such a fascinating topic. When I started in ESG, which was 2018, I knew there was a disconnect between what the end client, the end ESG client, the foundation, the investor wanted, and what the most of the strategies were being produced. And as I've learned and attended ESG events and impact events and learned about all the various strategies, I've come to kind of understand some of the barriers that we as an industry have to using ESG to its full potential. And so that's kind of the crux of the presentation. And then, as always happens, everybody has a whole bunch of questions about ESG. Like, is this ESG? Is this not? And it's such a fascinating topic, and I love the passion and the mess, and Larry Fink causing lots of good problems and bad problems about it. And so I'm happy to answer completely unrelated to this presentation, any questions you have about anything ESG, and also I'll give my contact information too if you have any questions or whatever that aren't appropriate for presentation, or we don't get to your question. I'm a portfolio manager and an ESG data expert, and that's why I kind of bring a unique perspective. A lot of ESG teams are separated from portfolio management teams at asset managers, unfortunately. And while that provides, say, better expertise and depth at ESG research, it separates the ESG data from the decision-making in security selection. And so because I'm a portfolio manager without a separate ESG team, I have to deal with the ESG data equally, and so do my other team members. And so that's why I talk about the subject, and I bring a unique perspective in that it is about true integration and a belief in true integration. I'm also the chief compliance officer, so I don't need to go through 6 layers of compliance to do a presentation like this. I'm not managing a $40 billion fund, so that's why I like to do this, and I also just like to share. I think it's important we as an industry are as collaborative as possible, and ESG. If you're not collaborative, I mean, ESG requires collaboration, and that's what I'm going to talk about today. In terms of what we're going to go through, I'm going to talk about shareholders versus stakeholders. I don't think it gets talked about very much in regular investing, let alone ESG investing. And I think it's the framework that's the key to using ESG data properly. I'm going to talk about all of the limitations and the opportunities, especially in the standardization of ESG data. And then I'll just tell you how we do it at Honeytree. And then I'm going to give a whole bunch of resources because everybody wants to know which courses to take and who's a great, academic and all that kind of stuff. So, and then we'll do questions. And sorry, I've cut the words off on the right, but you can move your video around. And I believe you got a paper copy of this. So stakeholder governance it's funny because that's the only type of governance I learned. So I came into the investment world having been trained in stakeholder governance. I've never learned about shareholder governance, shareholder primacy. I never took a course that taught that shareholders were the most important part of a business. I always was taught that customers, employees, community, supply chains, the environment, all that stuff, stakeholders all mattered to how business operated, how successful it was, and it probably has a little bit to do with my career before investing being in consumer insights, where large companies spent many millions and millions of dollars understanding their customer needs and wants and reactions to products. But I find it most interesting that a lot of the investment industry, particularly portfolio managers, have a difficulty grasping that in the context of security selection. So my thesis here is, in order to use ESG data effectively in portfolio construction, you actually need to throw out the idea that shareholders are the only thing that matters to the bottom line, and incorporate stakeholder governance framework. And stakeholder governance is relatively new as a concept. At the same time, I'd argue, I actually tweeted this yesterday, capitalism was always about stakeholder governance. Shareholders were always just one of those stakeholders. And you can argue about the history of economics and how that's interpreted, but employees and customers as core drivers of the bottom line has always been a practice of good companies throughout all of history, and has always been not companies that have not taken care of their employees and customers, or committed fraud or various other anti-stakeholder things in the pursuit of shareholder returns. There's a long list of failed examples of that. So that's kind of the dilemma we as an industry have. Much of our finance theory rests on shareholder primacy, and we need to undo that a little, walk it back to begin to make true use of ESG data. In our traditional portfolio construction methodologies in our industry, even if we do believe, so let's say I'm a portfolio manager, I believe gender and racial equity is important to the workforce, or I believe water use, or I believe saving, costs and wastes and those type of things are good for the bottom line. I may still have a portfolio construction methodology that makes those a secondary or tertiary input. So I have a valuation framework or factor framework or whatever fundamental or quant framework that I'm using for security selection. If I can't make room in that methodology or that model for things like diversity or environment, and it's a secondary or tertiary decision criteria, we're not truly integrating into ESG. So that's really what I've seen. I was pretty naive when we started in ESG. I thought most of the ESG strategies out there were portfolio managers as experts in the ESG data who believed in all this kind of stuff. And as I kept on getting questions about greenwashing and things like that, it started to be very clear that there was some functional barriers going on here. So this is what my main observation as somebody who came kind of from outside of finance and outside of ESG and walked in and said, what's causing all this disconnect between advisors trying to look for ESG strategies that aren't greenwashed, allocators trying to assess what's greenwashing, what's not, the end consumer not being able to find, a ESG products that meets their need. And it's not that the investment industry is evil. I mean, there's parts of it, like, we're not perfect. And it's not that we don't want to integrate ESG robustly in our processes. It's that there's these barriers created by our traditions and our theory in how we do stuff that make it very difficult to introduce new data that doesn't seem as important as financial data. Some of you will know the Junior League of Detroit and various areas. The last Junior League conference I went to was in Detroit. Actually, we stayed at the big fancy GM complex down by the water, which I'm sure you'll all know. I love Detroit. The food's great, by the way. And we went on a tour because the Junior League of Detroit had been doing a bunch of revitalization and community work along with many, many, many other orgs, because basically downtown Detroit had vacant, well, I mean, you folks will all know this. Everybody moved to the suburbs because of tax reasons, thanks to, the various historical things. And by the way, the art gallery is amazing. It's I always tell folks it's amazing. And then I explain that all the car companies bought all the great art in the early 1900s. But the reason I mentioned the Junior League is when I say I was only trained in stakeholder governance, it's because the Junior League actually does a really good job of training women like me in nonprofit stakeholder governance. And so if there's anybody in the room who isn't a member or has daughters, men are not allowed to join. It is a robust equivalent of a lot of the governance training programs, the corporate governance training programs, but arguably even better. And they bring in the best governance experts and put big conferences, and they send all the leaders of the Junior League. And there's lots of flaws in the Junior League, by the way, but the governance training and it is second to none. And so it was a very important part of my educational journey that had absolutely nothing to do with my investment education. And that's what the little JL logo on the right is. In order to, like, how do you even measure stakeholder governance? Like, how it's easy. The shareholder stuff is easy. It's like, are they the financials, are clearly aligned with, a shareholder primacy framework and that type of portfolio research. But, where do you even begin to, you can't just throw in a bunch of diversity stats and environmental stats and say, look, we've switched to caring about stakeholders. This little heart bubble, it was in our Q2 2020, maybe Q2 2020 report. We noticed that all the companies that we were holding talked about their employees first, then their customers in their quarterly financials or on their calls or whatever. And we realized a lot of other companies who we would say were not stakeholder governed didn't. They talked about financials for 3 paragraphs and then threw in a sentence about safety, whereas stakeholder governed companies that we were holding used team and employees and safety over and over and over multiple times, didn't even mention financials in those specific reports. And so we threw this little word bubble in our report. It's very advanced data science. But it really captures language, and it's not, it's not a single quantitative data point or anything, but it speaks to the company's belief of what is driving the bottom line, right? And so a stakeholder governed company knows that their employees and their customers are a core part of what drives the bottom line. And they realize the impact that they make on their employees and their customers is how they make money. And so that's the truly stakeholder governed company, of which there's been many throughout history, and there's a bunch now, big and small. It has nothing to do with size. That's what they're trying to do. At the same time, the end ESG client, it's not, you'll hear a lot of it's values, it's about my values. I want to invest with my values. I want to do good. That's absolutely true. But the ESG client that is coming to you, whether they're a foundation or an endowment or an individual, who really is the true end client, they believe companies doing good to the world will outperform over the long term. They see companies doing bad things to the world, whatever they may be, as a risk, and not an ESG risk, like a financial risk. And that gets lost in a lot of the talk that goes on, but just have your clients select values or have this and that. It's much more complex than just canceling out a couple guns and this kind of thing, and it'll drag performance, and that's okay because there's a belief among the end, and whether those be all millennials or that's why it's so popular in this group. Companies that have shitty cultures, pardon my swearing, companies that have a lot of turnover, companies that like the Canadian banks who forced everybody in certain parts back into the office can't hire because everybody else is working from home. There's the end ESG customer believes that needs to be taken into consideration in financial fundamental analysis. And the only way to do that is use some ESG data. Now, one of the problems with ESG data is that it's pretty new. And Accenture in 2016 was one of the, and sorry, somebody's going to knock on my door and my husband's going to come and get them. And sorry for the interruption. And sorry to do this. Oh, there we go. Problem solved. Okay. Sorry, our water heater broke on Sunday, and my husband was a bit behind. Anyways, snowstorm, and they could not repair it yesterday. Okay, so in 2016, Accenture was the first tech company to report any diversity data. So before that, nobody in the tech sector at all, and some other companies in various other sectors were reporting basic diversity data. So really, it's only been since 2016 that we could start, in the US. Europe would have been a little bit more ahead on some of the gender diversity stuff, but it's a very recent phenomenon. So all the deep work that ESG ratings agencies and folks have been doing for decades didn't involve the standardization, an ability to get a standardized set of data from these large companies. But since then, we've gone, we're probably at 80 or 90% of the S&P 500 reporting at least basic gender diversity data now. So we went from 5 or 10% in 2016 reporting any gender diversity data to now we're at 90%. Like even Coca-Cola has diversity data reported in their new report. Even Tesla's finally released theirs. But what's fascinating is now the leaders are also reporting racial diversity data at a relatively robust. And that's because the US has the Department of Labor, and the Department of Labor requires every company over 50 to report their gender and racial diversity by level on an annual basis. Now, they don't have to disclose it yet. I'm pretty sure the SEC is going to make folks start disclosing it, and whether that's just publicly listed or everybody. But basically what's happened is even companies without big sustainability reports because they don't have giant marketing teams to produce giant sustainability reports, most of which are a waste, by the way. They'll just put their EEO1 report up on their website. And so they're already collecting this data, and the data is already being standardized. And is it perfect? No. You'll see some firms, have no racial record for a whole bunch of their employees, but this is the kind of thing, takes time, just like the standardization of financials. One of the funniest things about ESG, and I will probably harp on this till they actually do something, is the worst reporters of ESG data are the asset managers selling ESG products. And it's annoying as somebody as a, one of the, I think the US is at 12% portfolio managers are women. Canada's at 11% portfolio managers are women. And so why I get really passionate about this topic is we can't just go out selling gender-linked products or diversity-linked products and not do the work on ourselves as an industry. And that's really why I like to do these presentations and rant on Twitter. We have to change our industry. We can't just embrace ESG and not follow the path that industrial and material and technology companies have done and made huge improvements. Like there's Midwestern industrial companies who have increased racial diversity in leadership from 5% to 15% in like 4 years. Same in gender diversity in leadership. This I don't want to say it's easy to do, but we as an industry can't keep on trying to pretend we care about ESG while literally not doing the work ourselves. So you also get into geographic differences. Like everybody in the US for some reason thinks Canada's super more equitable and more ESG and more environmentally friendly. We're not. We're way behind the US. We don't report racial diversity. Canada's just as racially diverse as the US, but we're behind on that framework. In Europe, they're ahead on the environmental reporting, and they're okay on gender equity, but they're not reporting racial equity at all, racial data, because they don't have a Department of Labor. And so you can only get racial diversity data for US-based employees of some of the companies that release it. But in the next 3 or 4 years, Canada and Europe will be reporting more similar to the Department of Labor framework in the US. And there's so much discussion on, I was on a regulator call a couple of weeks ago, and a whole bunch of folks, half of the folks were referred to the US. This is a Canadian regulator call. Half the folks referred to the US Department of Labor structure, including some of our larger pensions, as the template for which we're going to collect diversity data. And then you have a whole bunch of folks saying, oh, but diversity's, racial diversity is too difficult to collect, or we can't measure it, or those are poor excuses. It's absolutely possible to quantify and collect racial diversity data. What gets measured gets managed. If we don't measure it, we're never going to manage it. Same thing with portfolio managers. If we don't have a robust way to as a nation, both Canada and the US, to track, measure, and improve the number of women or racially diverse folks in portfolio management roles, we're never going to get anywhere. And simply saying that women don't like math is not a very good excuse, and something I get told all of the time in this industry. ESG scores are kind of like a fundamental score, right? And so they're third-party, research data. And the reason and there's a lot of great research that goes on in the very robust, deep research that goes on in the ESG rating houses. However, as I mentioned before, they can't produce racial diversity in leadership year-over-year data because only 60 companies out of the S&P 500 are reporting that. Maybe it's about 100 now. And so you can see they can't use that as an input. So what happens in a lot of the ratings is, because it was a lot of the ratings were made before some of this, and frankly, the data is not available for the whole index, they have to rely on a lot less actual results in more risk frameworks and goals and all this kind of stuff? And have you checked all the right boxes? And have you submitted this documentation here and that there and that there? And at the same time, you as a portfolio manager, an advisor, or whatever you are, wouldn't ever have a single fundamental score for a company, right? And so that's one of the problems with scores. And ultimately they really came about because a lot of portfolio managers were not the ESG experts, and they needed a framework and either external expertise or rating to either help them choose best of sector or, you know, knock some off. And it almost separated ESG data. Instead of ESG data being integrated, it got separated into the ratings. The future for ESG is not every company in the world submitting ESG data to 76 different think tanks globally who do some rating. The future of ESG data is it being standardized in the financials. And it is basically in process right now. I already mentioned the Department of Labor EEO-1 reports. That will become the world standard, mostly because the SEC is going to mandate it as part of the reporting and not as a separate document. It's going to be a standard disclosure in audited financials. And so we've already seen a big chunk of the companies that we look at with audited ESG data. So not just them pumping out stuff and doing whatever, audited emissions data. We're having been some audited on you know, but we're gonna be in a world in 5 years where it is you're spending as much on your ESG data audit as you're spending on your financials, which is great for the big four. At the same time, somebody needs to do this. So between the IFRS, so the IFRS has taken over the standardization of the useful environmental and workforce data into the financials. When I started in ESG, everybody kept on talking about SASB and all these frameworks. And I kept on thinking, but those are separate frameworks. They separate ESG. ESG, the useful workforce data. So pay levels, diversity representation, turnover, water use, waste, emissions, all of that stuff is quantifiable, fundamental company information. It may not be financial, but it's fundamental company information that is standardizable and mostly standardized in the GRI reporting framework or some of the other frameworks that are out there. And so any framework that separates ESG from financials is flawed. ESG data, workforce and environmental data specifically, it will exist in the audited financials. And whether that's 2 years from now or 12 years from now or somewhere in between, that's where we're moving. And the good news is it makes it a lot easier, much like standardized financials make things a lot easier to look at. It makes it a lot easier. And it's really, if you go, the data that I'm talking about, if you go to anybody's sustainability report, some people have combined reports already where they've combined their ESG data into their annual report. Adidas, Clorox are examples of those. The GRI report portion, which is usually only 3 or 4 or 5 pages, which has all the data in it. And then most sustainability reports are another 90 pages of like, blah, blah, look at our donations and our ERGs, which are okay, but they're not, you know, that they're more tick box exercises than actual evidence. You know, a company that's committed to stakeholders, that they can tell you all they want about their hopes and dreams and goals and their organization. If they're not making an improvement in women in leadership or racial diversity in leadership or reducing their water use, they're lying through their teeth. So that's why you need that data there to assess it. What's most fascinating about this whole thing is negative externalities. Now, I went to McGill and studied economics, and I didn't realize until this year. I always described it as I was taught by a bunch of left-wing economists, and I think that's because I was in Montreal. But I didn't understand why. And this year, if anybody's familiar with who won the economics Nobel Prize in economics, it was the gentleman who did the study on minimum wage not impacting labor force minimum wage increases not impacting labor force participation. And so that's the economics that I was trained in. But really, it was about negative externalities and the cost to society, and understanding them, and considering them in measurement. And we can't do that yet in investing, but we will as this data gets standardized. And so that's one of the things I'm most excited about, is how do we measure the cost? You have two retailers. One has a much lower wage and a much higher dependency on local social services and food banks and all these kind of costs that we can begin to get into. Hi, Ashley.
I just, on that point of just auditing data, if the big four aren't required to do this yet here in the US, who do you rely on as a good verifier of ESG data when you're looking at companies? I mean, do you utilize a fund manager that creates their own framework or only does this, or, what do you recommend?
If you're looking at corporate raw data, PwC, EY, and another one that I can't remember are actually the ones doing the assurance on the data. And so so you are trusting the company to a certain extent, but this is just going to get ramped up. There isn't anybody who actually audits funds or things like that. That's there's the new CFA GIPS framework. So I'm sure a bunch of folks got that email today. So much like GIPS compliance, I think the CFA ESG, I can't remember the proper words, that the claiming compliance with that and the auditing that will go along with that for managers and strategies will probably be the global standard in terms of process, but we're pretty new days on that. And basically, if you hadn't noticed, everybody's website has the PRI membership, and literally I can't even find an asset manager in North America who doesn't have an ESG paragraph on the bottom of their page. So it'll be, so signing the PRI and putting an ESG paragraph on your website does not mean you do ESG, and don't take that. I think that the CFA, much like GIPS, the CFA designation will be the most robust way. At the same time, what I tell folks to ask managers is ask them how diversity data fits into security selection, or ask them how it fits into security selection. And that's how you begin to assess kind of their level of commitment to the ESG that they're sending their ESG teams out to sell you. So we're in a fast moving data systematization and audit phase, and it's just the IFRS and the big four were not involved until 2 years ago, and now they've realized that they have to do it, right? It's them. If none of these other frameworks are going to work that everybody thought was going to work, and it's just really kind of exciting to watch.
I guess a little bit unrelated to kind of that auditing topic, but still consistent with the general theme of your conversation. When you encounter naysayers, or, a client that may come to you that may not be ESG focused and may ask you, what is the connection between ESG and company performance? What kind of an answer do you give to kind of give that person reassurance that this is a way to invest that will enhance their risk and return?
That's when we started Honeytree, every portfolio manager, all happened to be men that I told about it, they all said, but it's going to perform too, right? Like everybody, including my father, he's a portfolio manager, assumed introducing ESG data was going to cause constraints on whatever security selection methodology was there. I didn't have the barriers, so I understand why folks believe, because again, we are throwing traditional finance theory, to the wind and saying this other stuff matters. And so the answer that, and by the way, like environmental stuff, a lot more folks believe environmental stuff matters to the bottom line than the diversity stuff. And it really goes into cost of employees, culture, decent work, Facebook, I'll give the Facebook Cambridge Analytica rating. We use Glassdoor ratings in our research. Facebook, when they covered up Cambridge Analytica for 18 months, their internal employee ratings and sentiment declined. It started declining long before the Cambridge Analytica came to light. So all these aspects of culture, whether it's sexual harassment, equal pay, engagement, knowing why you're even there for purpose, they all are more tied into the bottom line. In our investment frameworks, we don't believe that they're related, but in our experience in corporations and in the world and in human interaction, we know that they're incorporated. And so it's really about you have to throw out a little bit of theory, but at the same time, I think everybody, whether they're a business owner or not, understands that the cost of hiring somebody who's left, or all these costs need to be considered when you're looking at financials, and they just add more of a view into how well governed a company is.
Sure.
Yeah,
and that helps, I guess. If you kind of consider some of the headlines that BlackRock CEO has been making recently, do you find him to be a help, or do you find him hurting the story at all?
His private jets don't help. Private jets do not help the cause of ESG, and it's really so. Larry Fink is right on stakeholder governance. He may believe it. Implementing it is difficult. So I have very strong opinion. So he hired, I forgot the guy's name, a CIO of sustainability who actually had no public markets experience, but that's besides the point, to head up the sustainability side of BlackRock. Now there's your symbol number one. If you have two separate CIOs, one in charge of financials, one in charge of the other stuff, they're separated. A chief investment officer, in my mind, should be an expert of it all. Whether you have separate research folks or not, that's a different story. But having a CIO of ESG and a CIO of investing suggests that the ESG is not the investing. So that's the first thing. Then this CIO quit, and he, published about 6 different blogs, and everybody kept on tagging me in them on Twitter, and said that companies, Larry's wrong, ESG doesn't make an impact. The only group in the world that changes anything is governments. Companies, large companies, don't make an impact. Their only job is to serve shareholders. So you can see even though he was the head of sustainability at BlackRock, was stuck in a framework that could not include stakeholders. And no offense, he's completely wrong. Governments not only can't solve all the world's problems on their own, they cause a whole bunch of the problems. So do companies. And the idea that companies are separate and not involved doesn't, most tech companies spend tens of millions of dollars a year on purely tax lobbying for their own benefit. So the idea that you can just leave companies alone and let the government solve these problems is completely flawed. Companies are solving these problems, whether it's packaging, shipping, innovation in various technologies. The good companies out there are solving these problems because it's a bottom line imperative. And the good ones are working in collaboration with government. So I don't think the jets are hurting. I don't think Larry's hurting. I think he's trying, and he believes. And BlackRock has some very reasonable, systematic ESG products that are arguably stronger than some others. At the same time, he's not dismantling the structure of inequality, right? BlackRock does not release their diversity data, at least in the last report that I worked at. So when Larry starts publishing the portfolio management team diversity and how he's going to improve it, because we all know it's going to suck, because that's the nature of our industry. When he starts putting out specific targets for reduction in his travel, when he does, when he, and thankfully, I don't think he forced everybody back to the office. And there's nothing wrong with working in person. Like, working from home forever is not like the ESG solution, but it's this, so he's trying, and he's got the right language, because it is about stakeholder governance. His article yesterday, I didn't read because I saw enough clips out of it. And I think he had some quote that was like, I'm not an environmentalist. It's about the bottom line. Well, no, it's kind of both, right? Like it's really, so, but at the same time, he's right. It is, destroying the environment costs money, right? And we need to kind of consider that. So his vote, I like the voting stuff. I think it was them. So they're going to have a lot of proxy voting engagement for like retail holders of stuff. So they're not the worst. They're definitely not the best, and I make fun of them a lot. But when they start releasing robust diversity reports, and when Larry starts realizing that that's a big part of ESG is changing our industry, then I'll champion him more. I think the SEC is actually doing the best job right now of like thinking through it, dealing with the existing data, and looking at where things are going, which is funny because it's the SEC. And they're actually like literally leading across all aspects of this and get it better than most asset managers. We'll call it the ESG light asset managers, as opposed to the real ESG large asset managers who live and breathe it. So yeah, it's he's not doing he's not as, I agree with him more than the CIO who quit that he hired, but he also hired that CEO, or CIO.
What is it about BlackRock's products that make them not the worst? I think, as you said, when it comes to ESG.
Well, for example, the Canadian banks have just as much ESG offering as BlackRock, just as bad diversity, and will not stop funding oil sands and argue a whole bunch of stuff. So that's what I mean, is on the scale of large global asset managers, and Larry's a good spokesperson of it. You don't see a lot of asset manager heads talking about stakeholders, right? Because so he's at least throwing that out there, even if it's in a flawed framework or attempt. And eventually he'll stop letting anybody see him get on a private jet, and it'll be interesting. But again, it's like, we're, as an industry, it's hilarious that we're leading this. We think we're leading this ESG thing. Good corporations are actually leading ESG. They're doing it on their own. They don't care what we do. They couldn't care less about the engagement teams. They're way ahead of. They're innovating in ESG because it's the bottom line. It's fascinating that we, as an industry, we think we're innovating at it, yet we lag so far behind so many other industries. And we already talked about this in our environmental and our workforce diversity reporting, which we're supposed to be using in all our ESG products research. So it's funny that even the leading European ESG managers, I've only seen, like the real ESG ones, I've only seen one with a diversity report. And like the bank sites, like, you have Bank of America, JPM, they release their diversity data, but they don't carve out the asset management or the capital market set, right? And so they're getting the benefit of a lot of underpaid women frontline staff, a lot of racialized underpaid frontline staff. Thankfully, I think it was Jamie Dimon has upped the pay of frontline staff to like $21 from $16 or something, which you'd think a bank associate frontline worker would get more than a Chipotle server, but so it's a lovely mess, and it's just so funny and that's, I think, a lot of the pushback comes from. The pushback comes from, does Larry or any of these folks really believe the ESG products that they're selling? And that's from people who hate ESG and for people who love ESG. And the other pushback is, you look at everybody looks at the top 10 holdings in an ESG strategy, whether it's active or systematic. And when it's index hugging, or all of the FANG stocks, or all of the mega caps, and nobody's made any discernment in there, and it's, not a S&P 500 minus 20 companies, folks get really skeptical, right? How is Facebook, Amazon, Nestle, how are all of those in a top 10 holding in an ESG strategy? And again, when you're BlackRock, you have 1,000 strategies, and they all have a bunch of different holdings, and so they've worked out a couple that are pretty good. But it's a fascinating dilemma.
All right, well, thanks. I appreciate that. I'll pause on some of the questions for you to continue on your slides.
Okay, I think I only have one more. So the reason it was easy for us to integrate ESG is because the firm I worked for before had a framework that didn't assume financial inputs were primary. It just had inputs into the research process. And the framework, and Bristolgate was the firm in Toronto, which nobody will have heard of, even though it's a $3 billion emerging manager US equity shop based in Toronto. And actually my father founded it. But we knew, my co-founder and I, we knew we could take that methodology, which had no fossil fuel and was really about long-term sustainable growth, cash flow growth, dividend growth, and the governance team's ability and the management team's ability to keep delivering that. We knew that was kind of pretty ESG already, and that we could bring in workforce diversity data, environmental data, to help us dig deeper into whether those companies were stakeholder governed, driven by purpose, whether they understood that their stakeholders were what was driving the bottom line. Ultimately, and I think I've already said this, our companies make money because of the positive impact they make on their stakeholders. Not because they feel good on that. Their bottom line is driven because of the positive impact they make on their stakeholders. And I think good portfolio managers throughout history who've understood systems thinking and how different parts of the business and culture and everything is integrated into success at management, especially stakeholder engagement, even just everybody knowing what the purpose of a business is. I think good portfolio managers have been looking at this stuff for a long time. It was just never separately framed under ESG, and then ESG comes along, and then the data gets more standardized. So we have a more robust way to look at it, and it's just a question of making use of that data, getting access to that data. And so I think the future is exciting in ESG. I get asked for a lot of resources. There's a lot of ESG organizations out there. Some are wonderful, some are a lot of pay to play. Like, all the problems in ESG are all the problems in the regular investment world, whether it's pay to play or whatever. US SIF is my absolute favorite, which is the US Sustainable Investment Foundation. I just call it US SIF. They have a course for practitioners and they have a course for regular folks. And I think one of them's free. They might both be free. If you're real, legitimate ESG, you've joined US SIF. It'll probably be the first large organization that we pay dues for. I think we're going to join this year. In terms of courses, Harvard actually has one. I think registration's closed, but it's not, well, I guess it'll be sort of a practitioner's one, but most of you are practitioners. So we've got the CFA courses. Concordia University in Canada does a self-paced or group legit practitioners sustainable investing course. So it's all either ESG folks from corporations or ESG folks or regular portfolio managers from the big Canadian pensions or the asset managers. We guest lectured one of their sessions, I guess, in the fall. That's one of my favorite courses. The US SIF has courses. There's a big course, like a real expensive course at the London School of Economics, and the CFA one as well. So those are what I recommend. I'd follow the SEC stuff on ESG because they're ahead. There's a whole bunch of stuff on our website. I've done a whole bunch of podcasts. We've done a whole bunch of blogs on kind of the various topics. So feel free to go there. George Serafim is a Harvard academic. And if you just Google his name, tons of either studies or like Harvard Business Review or pensions and investment articles that he's authored or co-authored will come up. And I think he's absolute, his framework is correct. And it's very different than a lot of the stuff we produce as an industry. So I would look at him. If you're on Twitter, follow me. I'll follow you back once I can assess you're not a random bot. If you, our job at Honeytree as an asset manager, we're very focused on RIAs and foundations and endowments. At the same time, we want to share, right? And whether that's being part of events like this, hanging out and meeting people who just want to learn about ESG, whether it's some, a hedge fund manager in the UK or a competitor in Toronto or an allocator trying to figure out how to figure out greenwashing among their managers. That's what we're here for. And my co-founder was actually the first ESG salesperson in the world about 15 years ago. So she was the first salesperson for Sustainalytics and then worked at MSCI. And so we like to be very collaborative, and also don't trust anything anybody says, especially me, but mostly investment firms. Be very skeptical. There is, some of you will remember, back in the 90s and early 2000s, we had stickers all over food that said like heart healthy, health check, low fat, blah, blah, blah. And it turns out they were all kind of BS because they were all a marketing ploy. I actually used to work in market research, and we did research around that stuff. Basically, companies would pay them $20,000, $50,000 to have that, on a General Mills cereal or whatever. And those are just labels. So most of the ESG stuff, a lot of the ESG stuff that you're seeing is just a label, and it's really about the ingredients, right? How the food was made and what the ingredients are much more important than any label. So just be skeptical, assume everything is fake labeled, dig into everything, ask the right questions, and that's my recommendation.
Well, thanks so much, Liz. If you have a couple minutes, we do have some questions that just came in.
Perfect.
Do you consider employee turnover or employee retention part of the ESG framework?
Right. Yeah, the data's not there yet. The data among manufacturers, for example, on like safety, is getting pretty robust because how it's been standardized for manufacturers. But turnover is the next step. Pay equity. So when we talk about the EEO1 report, the Department of Labor, that has racial and gender diversity by level. So then we're going to have pay levels, pay equity by level, and turnover by level. So those are the key data that will get into the standardized financials. Right now, a single employee turnover numbers kind of useless. And even if it's there, it's just like even the UK reporting on pay equity, where it's just all women and all men in the organization, is kind of a vague number. But absolutely anything that impacts the workforce, I would consider an ESG input.
What do you think the ultimate goal of ESG is? Do you find it just to be, an investment process to pursue? Do you find it to be a way to get companies that don't do good to be penalized in some way?
I believe ESG data is useful in finding companies that will outperform in the long run, because of the impact they make on their stakeholders. So it's ultimately useful for performance. That's not, it's useful, and at the same time, there's this brilliant cascading effect. It's like peer pressure, right? It took, 90 years for us to be okay with women being in the workforce, right? It'll take 90 years for corporations to really focus on stakeholders, and they'll be leaders. But so there's a huge benefit in the peer pressure of ESG reporting. That being said, a whole bunch of companies are never going to embrace it, right? And so I don't see, this isn't about making every company in the world ESG. Right? It's like, it's really, I think of it as the input, just additional layers of inputs into security selection, good management, right? It's really, what is good leadership and governance? And we can't figure that out purely with financials. So we need this non-financial data, and we can't make all companies well managed. So it's not about that as an end. It'd be great if they would, because then nobody would have to leave their shitty bosses and the turnover would be lower and the cost of society and all that kind of stuff would be easier. At the same time, then it would be, we wouldn't, like part of my learning is working for a large multinational in 2008 and 9 when they didn't really care about anybody and froze all the salaries and did all, and it was just poor governance, right? And they're a French company, but it's also like you can't experience the good if you didn't have experience with the bad. But yeah, no, it's not about making, if everybody just reports their diversity data and environmental data, it's not going to change the existence of these companies and their purposes, right? And so for me, it's really if we want to find long-term focused, sustainably growing companies, we need these inputs to assess. Also, what gets measured gets managed. So companies, when BlackRock finally reports their diversity data, Larry's going to go, oh damn it, we have to work on gender diversity and racial diversity and portfolio management and leadership roles. So there's a huge benefit. At the same time, he may also just like say he doesn't care, so, or it doesn't matter, or that they can't find any woman, there's no pipeline woman, so it's and lots of folks do, there's lots of folks who use ESG robustly that don't use it in security selection. To be clear, there's a lot of investors who very justifiably hold portfolios of securities, whatever they may be, and focus on the engagement, right? So the nuns were my favorite. The nuns will hold gun stocks and they'll go to the meetings and they'll do the shareholder proposals to get safety things added to the guns, right? So there's a whole bunch of different ways to do it, and they don't care about ESG data, but it's not, the work's not that different, right? Just because they're holding that company, they're trying to improve stakeholder safety as a result of their engagement. So there's a bunch of different ways to do it. For us, it is really about digging deeper into a company than we would with just financials.
Do you have your own framework for assessing, let's say, we'll just pick one data point as an example, water usage, at an automotive plant versus at a bank? Like, do you have your own way of weighting different factors across industries? And, how do, the big four, or whoever you go to to get your data, do they take that into consideration, or do they come up with their own weights?
So we use primary source company reporting for the most part, audited by the big four, but so we don't specifically, so a lot of the ESG frameworks will say things like water use matters in these industries and it doesn't matter in these industries. Diversity matters in these industries, it doesn't matter in the other industries. So we kind of, that's one of my issues with most of the ESG framework is diversity matters in all industries, water use matters in all industries. There's going to certainly be a lot more water intensity at a semiconductor manufacturer versus a San Francisco tech company with very little water use. That being said, 100,000 employees sitting in an office in San Francisco or their homes or whatever, use water. So absolutely, we have companies who have much lower gender diversity in leadership because they're science and tech companies, right? And so we look at the improvement. So same thing with water, right? It's not necessarily about and the water reporting is getting much more robust, where we have, water per unit production, water intensity, but it's like, what's the total water use? What's the water? Then there's a couple other kind of interesting things with water recycled, water estuarine, I can't even remember what it's called. But it's really, our framework allows for companies to either have something, a gap in their reporting, because you can only have a flexible framework when you're bringing in non-financial data, because, again, if we use racial diversity, none of the European companies are reporting racial diversity. How do you assess that? Just like, some companies have huge water use and others don't. And it's looking for the trends of improvement across all the data sets, right? Just like when you're looking at different sectors and financials, right? We don't expect the same growth rate in certain things out of utilities as you would out of tech, right? And so you have to make allowances for that. So but I dislike the idea that, diversity doesn't matter to X industry, or whatever doesn't matter to X industry. As the
Don't
data,
apply to all. Sure.
yeah, as the data, and really just look at the GRI reports, and you'll see, and some stuff's just not going to apply, and some stuff, but that's really up to the companies and their reporting and their auditors. At the same time, we as researchers have to be able to systematize or compare things, and that's the art of portfolio management.
Well, we have some other questions that I regret not being able to get to, but we appreciate your time so much. How does our member base follow you?
Twitter, you can send me a LinkedIn request. I really try and do LinkedIn stuff, and LinkedIn's algorithm just is not very helpful. My email's right there on the last slide, or you can contact the CFA folks to get my email. But yeah, follow me on Twitter. You can, and I do this kind of stuff all day, every day, and there's so many portfolio managers and CFA folks and endowment folks and everything on Twitter. And it's called FinTwit, by the way. It's like a really nice community. And I'm the ESG joker, I guess. And it's, anyways, it was great to, thank you for having me.
All right. Well, thank you again. And we will share your Twitter handle on our page, if that's okay with you.
Yeah, no problem.
All right, fantastic. Well, thank you everyone for joining us. Be sure to keep your eye out for your email for some other events that we have planned for the rest of this year. Thanks again, Liz.